4 types of capital and how it affects your business. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital advisory firm helping companies generating $1 million to $10 million a year in pre-tax profit to sell their businesses and secure capital. Today's video, we want to talk about 4 types of capital and how each one would affect, by taking on any sort of capital, your ownership in a business. So first type of capital will kind of work along the spectrum of basically how much equity one would have to give up to take on a certain type of capital. And of course there are other categories as well, but this is effectively generally 4 buckets as we are reductionists by nature here. And so at least give you some insight as to kind of how the different ecosystems of capital function or how they look at what they are investing and what they expect to receive in return. And so on one end of the spectrum is debt for a bootstrapped company, if you will. So the expression bootstrap means they're not taking in outside equity. The company is going to continue owning 100% of the business, and they're going to bring on debt capital to the extent outside capital is necessary, and debt capital basically being a loan. So a loan is taken on, that capital is utilized to grow the business, whether through acquisitions, hiring, product innovations, whatever it may be, and ownership retains 100% of the business. Second type of capital is venture capital. So generally speaking, these are early stage companies where the actual investment by the VC fund is not an enormous amount. Now it obviously can, as there's different rounds of venture capital, and the later stage and larger a business becomes, it can take on bigger chunks. But for very simple purposes, think of venture capital, angel investing, seed capital. It's all early stage investing. So the general kind of umbrella of early stage investing is effectively a Venn diagram of sorts with venture capital. And so venture capital in itself is smaller tickets than private equities. Think $1 to $10 million investments in a business, oftentimes. Obviously, there's a lot of bigger ones as well. And taking on a minority stake, oftentimes, of the business. Now, again, as rounds of venture capital continue, there's more and more equity that is being bought by outside investors, effectively investing in the company and taking on pieces of equity. Always in a rule of thumb is that when a company ultimately starts with venture capital and goes public, typically the founders own about 12% of the business. So, but that being said, the first swing of venture capital oftentimes can be a 10 or 20% stake in a company. And so it tends to be a small sliver of the business. Some companies thereafter decide to take on more venture capital or some of the other capital we're going to talk about, and others decide to just kind of bootstrap it the rest of the way and just use that to get somewhat of escape velocity in the initial innings. So third type of capital is growth equity. Growth equity typically comes in as a minority stake in a business, but a large minority stake in a business. So think 30 to 49%, so a non-controlling stake, but asking for either board members, asking for certain type of oversight of the business. So they are partners, if not minority partners in the business. But the idea of growth equity is that the business has kind of gotten beyond venture capital. Most of the time the company is profitable at this juncture and is somewhat meaningfully profitable. The growth equity is not as expensive, if you will, in that you're not giving as much equity away of the business as you would be in venture capital, because the business is a bit more proven at this juncture in this season of the business, and therefore that sliding scale continues along to our last category, is private equity. And so private equity, obviously a gigantic ecosystem going from the Blackstones and KKRs to the world to search funds, independent sponsors, family offices, and everything in between. Private equity's position is typically going to be less expensive capital than growth equity, certainly less expensive capital than venture capital, but still taking on an equity stake of the business. However, they usually like to have a controlling or majority stake of the business. So in private equity, oftentimes you'll see them come in and buy 100% of a business, of course, but where they're not buying a totality of a business, you'll see them buy 80, 90% of a business, and there'll be a rollover equity component, if you will, from the existing ownership into the next iteration or season of the business for the next 5 to 7 years before private equity either sells to another private equity, takes it public, or does whatever with the business. And so generally speaking, the sliding scale, if you think of capital, taking on capital for your business and how it's going to impact your ownership, stake, or percentage of the business, let's walk through that spectrum one more time. On one end of it, you're going to have debt. You're taking on fixed costs of having to repay the debt, but you are retaining 100% of the business and effectively bootstrapping it from there. You then have venture capital, smaller slivers of the business, yet typically a lower implied valuation or a more costly form of capital to take on. Then you have growth equity, companies profitable and humming. There's going to be a little more oversight, a little more control, still a minority share, and the capital being a touch cheaper than venture capital. And lastly, private equity, majority owners, majority control stakes, typically 80 to 90% if there's going to be a retained equity component, but implied valuations tend to be more aggressive than either growth equity or oftentimes venture capital, depending on the situations. So notwithstanding, there's a lot of nuance and gray in all of this, and so this isn't dispositive or exhaustive, but if someone were to say, like, what are the types of capital that you could get, and what kind of equity or percentage ownership of my business would I have to give up to get any of those, this is a good place to start. And so that's the thought for today. Hope the week's getting off to a good start for everyone. Keep pushing forward. God bless. We'll see you next time.